Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jargon so you don't have to prepare yourselves. Because today we are diving into JP Morgan Real Estate Income Trust, Incorporated latest report, and let me tell you there are some interesting distributions to discuss before we dive in if you are looking for clear no-nons. Ends financial breakdowns like this, make sure to subscribe to the channel and hit that notification bell so you never miss an episode. Also, we have a fantastic community over on Discord all about decoding these corporate documents. The link is in the description below, so definitely check that out after this video. So what exactly is JP Morgan Real Estate Income Trust Incorporated telling us today? It's a current report filed on the 28th of November 2025. This usually means something important has happened that the company needs to tell its investors about right away. And what happened? They declared distributions for their common stock. This is essentially the company sharing some of its profits with its shareholders. Think of it like a dividend, but for this specific type of trust. Now let's look at the numbers here. We see a breakdown for the record date of the 30th of November 2025. This date is important because it determines who gets the distribution holders of Class I, Class D, Class E, and Class Y common stock will receive payments. For Class I common stock, the gross distribution is 0.0411 per S-share. And here, as the really good news, no stockholder servicing fee. So the net distribution is also 0.0411. This means shareholders get the full amount. Things are a bit different for Class Y common stock. They also get a gross distribution of 0.0411 per S-share, but there is a stockholder servicing fee of 0.0078. Per S-share, this means their net distribution is 0.033. Per S-share, they take a small cut here. The report does a good job of explaining that the net distribution is simply the gross distribution minus any fees charged to service the stockholders' accounts. And here's a really interesting tidbit for Class D common stockholders. The stockholder servicing fee was waived for November 2025. This is a temporary break for them. But it gets even better. The fee waiver for Class D shares is essentially forever. This means that the value of shares held by current Class D shareholders will not be used to calculate any future stockholder servicing fees for Class D shares. This sounds like a pretty sweet deal for those existing Class D holders securing their fees indefinitely. The report also clarifies that Class I and Class E common stockholders have no stockholder servicing fees at all. That's another win for those investors, making it simpler and more profitable for them to hold those classes of stock. Now, looking at the bigger picture, this filing from JP Morgan Real Estate Income Trust Incorporated is primarily about distributing profits to shareholders. It tells us the company is generating enough income to share with its investors, which is generally a positive sign. The report is signed by Lawrence A. Goodfield Jr., the Chief Financial Officer and Treasurer. This indicates the accuracy and official approval of the information presented by the company's top finance executive. So what does all this mean for you as an investor or someone just trying to understand the financial world? This is a pretty straightforward report. It's about distributions, not necessarily about huge finance. C. Outperformance shifts like you might see in a quarterly earnings report. However, the details about the stockholder servicing fees, especially the perpetual waiver for Class D shares, are quite significant. They signal a commitment to rewarding long-term investors in that class and simplify the investment for holders of Class I and E shares the waiver for. Class D shares in perpetuity is a strong indicator that the company wants to retain those shareholders and make their investment as attractive as possible. It removes a cost that could otherwise eat into returns over time. This is a smart move for customer retention, if you will. On the flip side, for Class Y shareholders, a small fee is being applied. This isn't necessarily a bad thing as fees are common in these types of trusts, but it does mean their net return is slightly less than what they might have received without that servicing charge. The difference between Class Y and the other classes highlights the importance of understanding the fee structures associated with different share classes. When investing in such trusts, overall JP Morgan Real Estate Income Trust Incorporated seems to be operating smoothly and is actively managing its shareholder relationships through these distributions and fee policies. The perpetual waiver for Class D is a standout feature, showing a strategic decision to benefit a specific group of investors, likely those who have been with the company for a while. The company is demonstrating its ability to generate cash flow to distribute to its shareholders, while also strategically using fee structures to manage its investor base. This tells us they are focused on stability and long-term shareholder value, especially for their core investors who benefit from the waived fees. What are your thoughts on these distribution details and the fee waivers? Do you think the perpetual waiver for Class D shares is a smart move? Let me know your opinions in the comments below if you found this breakdown helpful. Please give this video a like and subscribe for more corporate insights. We really appreciate your support. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we will see you in the next episode of Corporate Decoder.